Over the past few years, gold has been steadily climbing to new highs, while silver has begun to follow the same direction. Headlines mention record prices, analysts debate charts, and social media reacts emotionally, yet very few people stop to ask a deeper question. What does this movement really mean? When gold rises, it is rarely just about profit or speculation. Historically, it has always reflected something much bigger happening beneath the surface of the global system. Gold does not suddenly become more useful as an object. Instead, it becomes more important as a signal. This video is not about predicting prices or telling you what to buy. It is about understanding why gold and silver tend to rise during certain moments in history, how those moments usually look, and why the current situation feels strangely familiar to periods we have already seen before. If you watch this video until the end, you may start to see money, value, and stability in a very different way. Long before banks, governments, or financial institutions existed, human societies still needed a way to exchange value. At first, this exchange was based on direct trade, where people swapped goods or services with one another. While this worked in small communities, it quickly became inefficient as societies grew larger and more complex. Over time, people discovered that certain materials naturally worked better as a medium of exchange. These materials had to be rare enough to hold value, durable enough to last across generations, divisible enough to be traded in small units, and universally recognized as desirable. Gold and silver met all of these conditions almost perfectly. What makes this particularly important is that gold and silver were not chosen by decree or law. Different civilizations across the world, separated by geography and culture, independently arrived at the same conclusion. From ancient Egypt and Mesopotamia to China, India, and Rome, precious metals became money because people trusted them, not because they were forced to use them. That trust is the foundation of everything that followed. As societies developed, gold gradually became more than just a means of exchange. It evolved into a symbol of power, authority, and stability. Empires accumulated gold to fund wars, build infrastructure, and project dominance beyond their borders. Kings and rulers understood that controlling gold meant controlling influence. History repeatedly shows that when governments begin to manipulate money, problems soon follow. The Roman Empire provides one of the clearest examples. Over time, Roman authorities reduced the silver content in their coins in order to finance growing expenses. People eventually noticed that their money no longer held the same value, prices rose, trust declined, and the economic foundation of the empire began to weaken. This pattern has appeared many times across history. Whenever currency loses credibility, social and political instability tend to follow shortly after. Gold, however, does not depend on promises or political decisions. Its value does not require belief in institutions, which is precisely why it has survived every major transition. For a long period in modern history, especially during the 19th and early 20th centuries, the global financial system operated under what was known as the gold standard. Paper money was directly linked to gold reserves, meaning governments could not simply create unlimited currency without consequences. This system imposed discipline. Spending was constrained, debt was limited, and inflation remained relatively controlled. However, such discipline also restricted political flexibility, especially during times of war or economic crisis. In 1971, the United States officially ended the gold standard, effectively separating money from any physical backing. From that moment onward, currency became a system based entirely on trust, confidence, and government credibility. Gold did not disappear, but its role changed. It became less a daily medium of exchange and more a reference point, quietly reflecting the strength or weakness of the monetary system. After the gold standard ended, the global economy entered a new phase. Governments gained the ability to expand debt more freely, central banks began actively managing markets, and inflation became a persistent feature rather than a rare event. Asset prices such as stocks and real estate increased dramatically over the decades, while wages grew at a much slower pace. The gap between financial assets and everyday living costs widened, and money gradually lost purchasing power. During this period, gold did not compete with stocks or real estate as a growth asset. Instead, it slowly reasserted its historical role as protection against monetary instability. Its rise was not explosive but structural, reflecting long-term shifts rather than short-term excitement. The current rise in gold and silver is not happening in isolation. It is the result of several powerful forces acting simultaneously. Global debt has reached levels that would have been considered unimaginable just a few decades ago. Governments now owe amounts that are extremely difficult to repay without inflation or currency devaluation. Historically, excessive debt has almost always been resolved through some form of monetary erosion, and gold tends to benefit in such environments. At the same time, central banks have been expanding the money supply through digital creation rather than physical printing. While this process feels abstract, its consequences are very real. More currency circulating within the system inevitably reduces the value of each unit over time, especially when economic growth cannot keep pace. Another crucial factor is the gradual erosion of trust in institutions. When people begin to question governments, banks, or financial systems, they instinctively look for assets that exist outside of political influence. Gold and silver have filled this role for thousands of years, not because they are exciting or innovative, but because they are familiar, tangible, and independent. Perhaps the most telling sign is the behavior of central banks themselves. These institutions operate cautiously and strategically, yet in recent years, they have been increasing their gold reserves. This suggests long-term preparation rather than speculation. Silver occupies a unique position that differs slightly from gold. While gold is primarily viewed as a monetary asset, silver also plays a critical role in modern industry. It is used extensively in electronics, renewable energy technologies, medical equipment, and advanced manufacturing. As technology continues to expand, the demand for silver grows alongside it. At the same time, silver supply is limited, and mining production struggles to keep pace with industrial needs. Historically, silver tends to move after gold, often with greater volatility, which makes it both riskier and potentially more powerful during certain cycles. Many people argue that stocks outperform gold over long periods, and in stable economic environments, this is often true. Stocks thrive during growth, innovation, and confidence. Gold, however, serves a different purpose. Its role is not to maximize returns, but to preserve purchasing power when systems are under stress. Gold performs best during uncertainty, transition, and restructuring. It acts as a form of insurance rather than a vehicle for rapid growth. And like any insurance, its value becomes clear only when something goes wrong. It is important to acknowledge that gold is not without consequences. Mining operations have significant environmental and social impacts, particularly in developing regions. Forests are destroyed, water sources are polluted, and local communities often bear the cost of global demand. Gold has always reflected both wealth and inequality. Its story is not purely about security or preservation, but also about the uneven distribution of power and resources across the world. Throughout history, major transitions have tended to share common characteristics. Periods of currency instability, political tension, and shifts in asset valuation often occur together. During these moments, gold consistently rises in importance, acting as a reference point rather than a solution. These patterns do not suggest that the world is ending, but they do indicate that systems are changing. Gold tends to rise quietly during such times, not out of panic, but as a form of preparation. The rise of gold and silver today is not a call to fear or panic. It is a reflection of uncertainty, restructuring, and adjustment within the global system. Gold does not predict collapse. It responds to imbalance. The more important question is not whether gold will continue to rise, but why modern systems require such protection in the first place. Gold remains unchanged. Systems evolve. Currencies shift. Institutions rise and fall. Gold simply observes and responds. And when it rises, it is usually worth paying attention. If you found this breakdown valuable and want to better understand how money, power, and global systems actually work beneath the headlines, make sure to subscribe to the channel. We focus on long-term thinking, historical patterns, and the deeper forces shaping wealth and society. This is not about hype or quick profits. It is about understanding the game itself.